Welcome to this Killik Explains finance video. This week, a topical topic, how income investors can spot dud dividend stocks. So, the hunt for a decent yield continues, more pressure is being put on income generating assets, more companies under pressure to deliver dividends, so watch out for evidence that a firm is basically starting to fish around using slightly dubious methods of generating income. So, the risk is mounting that a company becomes wedded to its dividend and will do anything to sustain it, says FT Advisor. Companies that pay income know they've got to keep doing it. Shareholders expect the income to keep flowing in the form of dividends year in, year out. Now, the backdrop is this. Interest rates are at record lows. Income generating assets are therefore in demand. Companies that can demonstrate they can generate income are popular. Finding decent yields is therefore getting tough for investors. As the price of those high quality safe assets is driven up, yields fall and the hunt continues. So what we're seeing is investors being tempted potentially to buy shares purely on the basis of yield, not looking under the bonnet carefully enough. By doing so, underestimating the risks or even wishing they weren't there, if you like, and proper dividend screening is therefore vital. Now, question that's relevant to this is what is proper dividend screening? So I'm saying it's no good just going for companies with high yields. That is just a sign that you've got a generous dividend in 1 year, but it doesn't tell you anything about future sustainability. So what does? Well, traditionally, something called dividend cover. So you'll see lots of focus on this. Basically, dividend cover is the relationship between profits available to pay dividends and the annual dividend. The higher the multiple, the greater the cover, the safer the dividend stream is the logic. But here's your problem. According to the Share Centre, the largest 350 UK stocks have average cover now of below 1, 0.8. Now, you might be saying, well, so what? Well, basically what that's saying is the typical firm has less annual profits than the size of the dividend it's promised to pay. How's it doing it? Well, the calculation allows you to use reserves from previous years and so on. So they've got a buffer, some of them. But it's a problem. If you're screening for decent dividend cover and you look in a textbook, it'll say, don't accept a stock with dividend cover of less than about 1, 1.5, even 2 times. And you're looking at basically a whole load of stocks that have got less than 1. So where do you go from there? So dividend cover is low. That doesn't mean you're not going to buy dividend stocks, by the way, but screening on that basis is becoming tricky. And you can see the trend. So dividend cover used to be a lot higher, 1.5 times a few years ago, then down to 1.2, now below 1. So what are we going to do? We're going to try and test a company's financial strength in order to assess whether it can continue paying dividends. Now, I've done other videos on this. I'm going to cover another topic in a moment, some sniff tests if you like, coming up. But what I'm suggesting is fish around, look at financial strength, look at the cash flow statement as a starting point. So in other words, look at the relationship between what's called operating or free cash flow, that's operating cash flow after interest payments and after the amount set aside to maintain assets, to the annual dividend. Look at things like the Petroisky F-score, easy for me to say, not going to cover it here. One for the techies, if you like. And for people thinking that all sounds a bit like science, hard work, well, I'll suggest 3 red flags, if you like. So 3 trends that suggest a company may be running out of ways to maintain its dividend. And that's where you've got to be careful, because if you're relying on this company for income, be careful. Maybe it's no longer a good bet. Now, what are these 3 sniff tests, if you like? If you get them all together, then crikey, watch out. Number 1, taking on debt. I have a problem with companies borrowing. Interest rates are low. It's like you borrowing to buy a house, but why are they doing it? So the key is with interest rates low, firms can borrow cheaply, and they have done. Dividends can be sustained with borrowed money. So basically you borrow the money and you use it simply to keep your equity shareholders happy. So it's coming in one side of the business, going straight out the other. Now that is not sustainable, all right? So debt, long-term funding, should be used to buy long-term assets. That basic matching, expand the business, all right, or maybe restructure the business, not simply to keep the dividend flow going. So look out for rising debt with little or no growth in sales and or earnings. In other words, evidence the cash is just being pulled in and siphoned straight out. That can't be sustained forever. Number 2, asset sales to pay for dividends. Now, of course, you're going to sell assets from time to time. You'll restructure, dump surplus assets and so on, but it's what is the cash being used for? So, companies that do this know there are other firms out there with money to spend. We're in an environment, quantitative easing, liquidity pumped into the system. Okay, so there are companies out there with money, and companies that need money can just offload assets, clearly decent ones potentially, in order to pay dividends. In other words, raise money, use it to keep shareholders happy. Keep the illusion going that you've got a regular way of meeting those dividend commitments. All right, so look out for, now there are lots of things to look for, but if you want sort of one thing, look for a mismatch between asset sales and funding. So where is the money being applied? And you do need to do a little bit of work on the cash flow statement here. In other words, is the company using the money to pay down long-term debt, for example? That could be a good thing. Or is it simply using it to sustain the dividend policy? Number 3, reduced investment. Clearly what a company can do is pull in the purse strings a little bit and say what we'll do is not invest in our future, we'll just keep our shareholders happy in the short term. Again, not good. So a cash-strapped company looking to save cash can cut investment. This may allow them to fund dividends in the short term, but you can't keep doing it. And basically evidence that this may be going on, well, there's various ways of finding it, but compare research and development, if you know how to look at a set of accounts, to sales, look for changes in that ratio, look for companies trying to eke more juice out of their existing lemons, as I call it, by extending the lives of assets they've already got because they're desperate not to have to try and replace them and use the cash in that direction, changes in depreciation policy and so on. So keep an eye out, there's various red flags that suggest maybe what the company's doing here is reducing investment simply to churn out more dividends, but it can't last. Now, lots of ground covered there, lots more analysis sitting behind what I just said. So any questions, editor@killik.com. And if you're wondering about some of those videos I mentioned on how to analyse cash flow, free cash flow yield, all that good stuff, please feel free to go to our library, killik.com/learn, and a good place to start looking would be the Shares tab.